Hello trading friends and welcome back to Forex Focus, brought to you by IG. Taking a look at the Japanese yen collapse, why we've seen this resurgence in US dollar strength and Japanese yen weakness, how crazy it is historically speaking. We're going to look at decades worth of data here today, as well as some recent economic data from Japan to try to pinpoint why exactly this is happening, how it could get better, but also how it could get worse. Highlight both sides of this coin, so to speak. But let's start with how we got here. And if you've seen anything concerning Forex markets and central banks and interest rates and the whole synergy between those entities, you've seen that the US, Canada, Euro area, UK, Australia, most major economies have been hiking interest rates in recent years to combat high inflation brought on by the economic boom we saw coming out of the pandemic. Not so much in Japan. They actually hiked interest rates recently to a whopping 0%. They were at negative 10 basis points. And that was actually the first hike from the Bank of Japan since 2007. They've been doing nothing but cutting rates since the financial crisis, and interest rates in Japan haven't exceeded 2% since the mid-90s. And so you have, right at the start, really the main reason that you're seeing Japanese yen weakness permeate, not only Forex pairs, it's not just the US dollar, we'll cover the pound, but it's also Euro yen, seeing strength for that Euro relative to this Japanese yen. The big piece recently has been the fact that these other major economies have had higher interest rates and thus higher demand for their currencies to invest at those higher interest rates than in Japan, where buying yen and investing in Japanese debt markets would get you potentially negative interest rates in recent years, and right now from the BOJ, a 0% interest rate. And a lot of people thought that this hike to 0% might be the start of the Japanese yen comeback story. But since the hike, central bankers in Japan have been pretty hawkish, and they're stuck in a tough spot, right? And keep this graphic in mind, because you're about to see essentially the inverse of it, which is the Bank of Japan's balance sheet. And you have now a situation where Japan, like everybody else, committed some quantitative easing at the outset of the pandemic. You see both in the red line, that's the US, and in the black line, that's Japan, a run-up in the balance sheet around 2020, coinciding with the pandemic, and most central banks, like I say, easing at that time and buying more assets and reducing interest rates down to 0% to try to spur on what they thought was going to be a struggling economy post the shutdown and lockdown of the pandemic in early 2020. And then you saw the comeback story, especially in the US GDP, but also in the Euro area and UK and Canada and Australia. But you didn't see that same comeback story in Japan. Japanese GDP stayed relatively soft throughout the 2020 until now period. And so they weren't able to reduce that balance sheet. And now you have this GDP growth rate for the last couple of years. And you don't see many growth rates higher than 2%. And you see a handful of quarterly growth rates from a GDP perspective that are right there around 0%. So relatively little growth, and you just saw that high balance sheet and 0% interest rates. And so it's a little bit of a standoff in an environment like that, right? Because the central bankers want to keep that high balance sheet and low interest rates to try to spur on this GDP. And without that GDP growth, they don't feel comfortable reducing that balance sheet and hiking interest rates. Whereas, for example, in the US, they increased the balance sheet, they reduced interest rates, And the U.S. economy saw great growth in the latter part of 2020, 2021, and honestly on into the present. And Japan, with their ultra loose monetary policy coming out of the pandemic, it was already around 0% going into the pandemic, and then being in negative territory for the last couple of years here. Not seeing that GDP growth has kind of held the central bankers hostage in being afraid to hike interest rates or reduce that balance sheet. And that story, that example that I just told you, is a primary reason for why you're seeing such great US dollar strength relative to the yen. Now, this market has come off of its highs, but keep in mind that that spike up north of 155 all the way intraday trading, I believe it was a Sunday night into Monday morning, where the US dollar yen pair here got all the way up to 160. Those are highs since 1990. So more than 30 years worth of historical data. And the levels that we have been trading at recently are some of the highest for US dollar and lowest for Japanese yen relative to that dollar. And again, it's because the US economy has not only been witnessing consistently high GDP growth rates, higher than Japan, since the pandemic, but they've been able to do that with 5% plus interest rates. Keep in mind, the Fed from 2021 until last year hiked interest rates from 0%, like I say, where pretty much everyone was around the pandemic, to above 5%, some of the highest interest rates of any major economy in the world here in the U.S., and U.S. GDP has continued to outperform Japan's. And so you're not only getting the higher demand for U.S. dollars to invest at a 5% plus interest rate relative to a 0% minus interest rate, like I say, at certain points negative in Japan. Not only are you getting that demand dynamic, but you're also getting just a relatively stronger economy in general, even adjusting for a more hawkish and contractionary central bank in the Fed relative to the dovish Bank of Japan for the last several years. And so, like I say, people thought that this hike from Japan might be the start of a Japanese yen comeback, but the central bankers there continue to talk dovishly about the fact that they're, cognizant of their balance sheet being so relatively high compared to even the U.S. And people complain about the balance sheet in the U.S. and other major economies like the Euro area and elsewhere. Japan having that problem, but not able to see the economic data to work on that problem even, and thus you're getting these 150 plus. It's crazy. 150 has now become relatively normal for dollar yen trading, and that used to be the 30-year high that the market would trade near in recent years, but not trade too far beyond. Recently getting up above 155, and even intraday on that one day there trading all the way up to 160 US dollar versus the yen. But it's not just the US dollar, my friends, trading near historical highs. You've got the pound yen and the euro yen. You can go take a look on the IG platform at that one. But here we have the pound yen for you. Not as big a historical extreme, because you have to keep in context that the US dollar has been the relative outperformer of pretty much every major currency in recent years. But this pound yen getting up to close to 200 yen per pound in recent trade. And if you go back to the last 20, 30 years of data, you can see that this market could get up to 220, 240 as it has historically. Now, that being said, keep in mind that dollar yen, for example, historically speaking, trades closer to 70, 80, 90, 100 yen per dollar. So could fall looking at historical prices. But this yen story could get worse, especially if these trends continue in this direction of US and UK and Euro area outperformance from an economic data standpoint, and central banks, even if the US and Euro area and the Bank of England were to cut rates slightly, normalize them lower slightly, if the Japanese interest rates stay near 0% and their balance sheet continues to be so much higher than these other global economies, this yen could get worse before it gets better. But we'll continue to monitor the yen price action as well as the Japanese economic data as it comes out this year.